Happy to be part of the symposium today and to talk to you about CMHC's program to help you finance or arrange insured financing for your new rental construction projects. So what I'm going to be covering today is our features, so our product features, our eligibility, so criteria that you have to get to qualify for mortgage loan insurance, and then I'm going to walk you through an example of an insured financing transaction. So looking at the borrower eligibility, mortgage loan insurance is available for personal or corporate borrowers. The borrower's net worth must be equal to at least 25% of the total loan amount. We do like to see borrowers with very deep pockets. The corporate borrowers, for corporate borrowers, additional personal and or corporate guarantees are required. And guarantee structure on the takeout financing side of it is 2% for every loan amount above 60%. The additional guarantees during construction will be 100% of the loan amount until such times as the rent stabilizes. And we define stabilization as income sustained for at least 1 year at the projected rent levels. And CMHC also may require personal guarantees above the 2% for each percentage in certain situations as well. Looking at construction contracts, a fixed price contract is required with a general contractor, which is our preferred method. A construction management approach is also acceptable. If this approach is used, at least 2/3 of the hard costs, including major contracts such as structural, mechanical, electrical, form, and concrete, must be typically signed prior to the issuance of the first advance. The contracts are to be assigned to the approved lender as well. Bonding requirements. Bonding is required to ensure a responsible contract performance and financial securities in place in the event of default by the builder. Bonding requirements normally include 50% on labor and material and 50% on all major contracts, including structural, mechanical, electrical, form, and concrete. As an alternative to bonding, irrevocable and unconditional letter of credit equal to at least 10% of the project's hard costs are required and may be considered. And that's usually for smaller builds under 50 units. So looking at bonding requirements a little bit further, the waiver of bonding requirements may be considered at where the builder is established, financially sound, and the project is within average size and price for the location and is of a common architecture. In addition, the lender must receive a concurrence from the project monitor to waive the bonding requirements, ensure the subcontractor has adequate experience and contracts and has had contracts of a similar nature and size, and the lender must perform a satisfactory credit check on the subcontractor as well. So with respect to the project monitor, the role of the project monitor is to be performed by a quality cost surveyor who is a member of a national or regional professional quality surveyors association. As in some regions there may not be a regional association, consideration can be given to accept an experienced project monitor recommended by the approved lender with at least 5 years experience with rental construction projects of a similar size and a construction nature. The project monitor is required to have adequate errors and emissions and other liability insurance in place. Looking at construction advancing, the loan amount may be advanced during construction based on the lesser of 75% of costs or lending value, subject to a rental achievement holdback. CMHC will recognize the market value of the land in the cost calculation, and the first and last advances are always to be reviewed and agreed upon by CMHC. All advances are to be supported by a project monitor's report and based on the cost to complete method up to the approved mortgage amount only. So now I'm going to walk you through an example of an insured and an uninsured transaction. This example is based on a 24-month construction phase and assumes that a long-term financing will be the construction and takeout financing will be insured by CMHC. So this is an 80-unit concrete high-rise that we're comparing. CMHC insures construction and long-term financing as one transaction. In this example, an interest rate differential of 1.25 point was used to reflect the reduced interest rate a lender may charge on a CMHC insured application. The rate is negotiated by yourselves, by the borrowers, with your approved lender, and it depends on various factors. As construction loans are typically advanced on a monthly progress draws, the interest costs are based on a 60% of the total construction loan being advanced over a 24-month period. The lender fee of that 1/4 point is usually reflective of what a lender may charge on an insured transaction. So the potential for the cost savings during construction with this, on this example with CMHC insured financing is evident. So that's all for me today.
Okay, great. Thanks, Paula. Okay, so we're going to ask a series of questions to the panel and just move through this real quickly. Jeremy, first question for you. Just what % of your business, and maybe Ryan also, what % of your business is CMHC insured in the apartment sector?
Thanks. Okay, so I'm Jeremy Wedgbury. I'm Managing Director of the Commercial Sales Team at First National. I think we're very well placed to talk to you today about apartment financing and in particular apartment construction financing. From the perspective of sort of a 2013 numbers for First National, we're going to do what I consider to be a fairly staggering number of probably $3.5 billion of term financing and construction financing. The bulk of that will be CMHC insured. I'm going to estimate probably $3 to $3.2 billion. And that includes our renewal business that we would be operating in. So we do typically about $2 billion of new business each year. And because we've been so active over the last 5 years, we've got very large renewals that we're dealing with these days. So we're going to be looking into the $3.5 billion range, sorry. In terms of construction financing, whether it be CMHC insured or whether it be conventional financing that we would do, I'm going to estimate anywhere from $300 to $500 million per year of construction financing.
Okay, good. Ryan?
The percentage-wise, we're pretty close to the same thing. I think on the takeout stuff, you can't deny the rates CMHC gets you. Everybody wants it. It's pretty much there. Now with construction kind of creeping in, I think people are trying to push for, let's build it, let's stabilize it, let's get CMHC after once we can prove the rents. But I think everyone really wants to get CMHC on board because the rates are just that much better.
Right. Sandy, what are you seeing in the loans you're doing?
Basically the same thing. I mean, our business is more presenting options so that they understand what else can be done.
Good. Greg, you're a borrower. What are you doing for financing these days? What % is CMHC?
Very small portion.
Why is that?
Speed.
Speed. Interesting. Okay. I want to jump sort of right to the pro forma. When you're looking at penciling out an apartment deal, we've got to spend time talking on many panels about this today. How do you get comfortable around the rent levels on a projected deal? What vacancy rates do you use? What do you do about taxes? And what number are you comfortable using R&M with? So when you're looking at the pro forma, what are you looking at? What are you happy with? What's keeping you awake at night? Jeremy?
Yeah, I mean, there's obviously a lot. I mean, there's a great deal of detail. I mean, we obviously would look at things like a feasibility study, or at least the information that would be contained in a feasibility study would be the same type of work that we would be doing. We've got, in terms of apartments in our portfolio, we've got about $12 billion of apartments in our portfolio. So that gives us a great deal of advantage from the perspective of having market information in terms of where rents are. So it's quite likely if a borrower brings a deal to us, and I mean, we do construction deals right across the country. You know, I was thinking about it before I came up on the panel today. I was thinking, you know, we pretty much got a construction deal going on in every market, every major market in the country right now. They may well be small ones. I mean, there may be a $3 million construction loan in New Brunswick, whether it be the same type of deal in Halifax, or very large transactions that we're doing maybe in Toronto. But I mean, for us, it's really about looking at the numbers, digging inside of them. We want to get a sense of the rents that are being used in the pro forma, and then all of the expenses. So we're going to look back across basically our portfolio, see where the expenses shake out, see where the rents shake out. And obviously, we put a huge level of diligence into our borrowers. So I mean, we've got 5,000 customers. So we're really we focus very much on customers that have either had success in the marketplace with other lenders, or have more particularly, hopefully, had more success with us. So we look very much at the strength and experience of the borrower, and then the details in the pro forma.
But you're saying your book is big enough that you know what's going on in all these submarkets, generally speaking.
Absolutely. I mean, but that doesn't necessarily help with maybe an inexperienced borrower, for example. You know, so, and you know, we've encountered all sorts of issues right across the country in terms of, you know, bad general contractors, things like that get borrowers into trouble, cost overruns, things like that. So you may well have a contingency built into your budget, but it may well not be enough. You know, so again, you know, we will look to the strength of our developer and borrower to make sure that they've got the ability to work through the issues.
Okay, Ryan, same question. When you're looking at that pro forma coming in from the developer, what are you drilling down on, and where are you looking for backup information?
We would rely heavily on the feasibility study. I think a good feasibility study up front is very useful. It gives us a lot of data. We do have our existing book as well, which has great comparables, but much like the CMHC data tends to be historical, tends to be on older stock. So when you are building a new, you know, high-rise apartment building in Toronto to condo standards, it is much more difficult to extrapolate that data, come up with an actual rent that is achievable in what you're going to get, and then get a comfort that you're going to get it with no pre-leasing to date. So the feasibility study is going to go a long way to kind of help us bring that through. And then it's a matter of us talking with you, and we do rely heavily on the borrower as well to say, you are the expert, and your money's the one going in first. Help me get there, and you know, and hopefully we can.
You know, Paula, yesterday you talked a little bit about the retirement home industry and how, as the industry evolved, the data coming to you and the loan applications evolved and got better. You sort of expect to see the same thing in the apartment business. We're still in early days here, right?
Absolutely. As more stock comes on stream, we'll have better feasibility studies, better comparables. Like the other two gentlemen stipulated, the feasibility study we rely on heavily, but we also have internal databases of insured transactions going from coast to coast to coast. So we look back at historicals, and they're not the best comparables, but we know where things have started and kind of evolved. We also have internal departments that we would rely on, like our market analysis department that actually surveys all the different cities and towns across the country. So we would pull them in, and we'd also pull in our appraisal group that would help us find what we'd like to think as close to possible as the right number. So that's
okay. So Greg, a question for you on mezzanine lending. I'd like you to briefly describe your program. So if you're going to build $100 million worth of apartments, you're going to need $30 million in equity. Jeremy, Ryan, about?
Yep.
Right. That's a big number for a developer to come up with. So Greg, talk about, you know, you're a mezz lender in this sector. How do you look at deals? You know, and what are developers doing right and what are developers doing wrong, and how are you choosing deals to participate in?
Okay, so that's a lot of questions in one sentence.
We're tough for time. So.
I'll say what we're looking for is, you know, project feasibility. Second would be the quality of the developer. And our third criteria really is, do we want to own it at the end, potentially, because we're long-term owners and buyers in the space. And even though we may not be contracted to buy it or optioned to buy it, we'd look at, if something goes wrong, we're prepared to own it. But the way our program works is essentially we're prepared to lend money just above the equity to an experienced developer.
Can you say up to what level you go to on a $100 million deal if you got 70 from these guys?
We'd expect, you know, we might be up to 85%. So we'd be expecting like 15%, but that can be in form of land or other covenants.
Okay. All right. So let's talk now about, you know, how you approach value as a lender, as an insurer, as a mezz guy. Is it income driven, cap rate driven, replacement value, construction cost, debt service coverage? How are you looking at the deals, Jeremy?
Well, I think it's a combination of all of those. I mean, I think we have to be very careful with cap rates right now. I mean, they are exceptionally low right now, and it's making it quite economic to start to look at construction again. So But we rely on all those factors. I mean, we're looking out, depending on the project, if it's a small one or a large one, 12 to 24 months. We're looking at the cash flow because we want to make sure that we can get back out of the loan, i.e., can we do a term loan on this at the end? That is our exit. So debt service coverage is, of course, is a driver of that. So if we don't see ourselves with a normalized interest rate on the property, sort of 18 to 24 months down the road, if it's not going to cash flow at those rents, and of course we're going to do some sensitivity analysis on those rents to make sure that it is going to work at the end of the day. And again, that's where it factors back into the strength of our borrower. So if we're dealing with a very strong borrower with a large portfolio, we know we've got a little bit of latitude there. So, that's going to drive how much latitude we actually provide. But, I'd say we look at all those things. I mean, certainly replacement cost is something that's a big driver. But we're looking at sales in the marketplace in the current market to see what the benchmarks are in terms of, sales. So if we're seeing sales in the market at $175,000 a door, we may well be comfortable in that. But again, a lot of that is driven based on the current cap rate environment. So when you see cap rates at 5 to 5.5%, it starts to make these construction pro formas look better. If we start to move cap rates up to maybe more normal levels, you're going to start to see some of these maybe go off base a little bit. And so that would give us a great deal of concern.
Okay, Ryan?
Again, very similar. Cost takes a much bigger factor for us in development because odds are you're building it to make some return and create some value for yourself. Cap rates give us comfort, but they're not really driving our loan amount. Right. In this cap rate environment, you're well above both cost and your debt service coverage, and those would probably take a much bigger role when I'm looking at a construction project.
Okay, good. Sandy, any comments on that?
Yeah, we just find when we're taking it to the lending environment that its debt cover is much more important than lending value. It's a much more controlling factor. Everybody's chasing the loan to value because that's a benchmark that they're more familiar with, but the borrowers need to be more concerned with what rental achievement do I have to get to and what debt cover will that provide for the takeout, which still has to match off for your construction loans.
Okay, so let's have a discussion on what you think cap rates would be for a brand new apartment building in Toronto. We haven't had one build and sell yet. We've sold a number in Ottawa and in London, and you guys have seen those deals. They kind of come around a 5.5% cap rate. They started a couple of years ago 5.8, 5.9. The last one in London, I think, was 5.4. So we've got some transactions that have occurred outside the GTA. We haven't had one new building sell in Toronto yet. If you had a brand new building at Main and Main, 150 units, the right building with the right amenities and things like that, what's the cap rate today? Greg? No, I know what number he's going to give. He's a buyer. Jeremy, yeah.
Well, I think we're going to be probably more on the conservative side. There's no upside in rents available in the property.
So can I just stop you there? That's a key point you just made. Because a lot of times developers see these deals at Yonge and Eglinton.
I love getting to talk first. It's fantastic.
So developers see these, you're just in my eyesight, I guess. Developers see these 3 and 4% cap rates happening at Yonge and Eglinton, right?
Right.
And they say, well, if that old building can sell at that price, then my building should be worth more. Well, it's not. And the reason that's selling at Yonge and Eglinton at that price is because there's lots of juice left in that. Right?
So we're doing a deal right now, Derek, in Vancouver. It's a $60 million construction budget, and our borrower was definitely thinking that it was probably a 4 cap type deal. And we went to the marketplace, had it appraised, and it appraised at a 5 cap. Right. So that sounds like a very high number for Vancouver. It's a great location in Vancouver, but so our borrower was very, very surprised and expected a much lower cap rate.
I would have too, in Vancouver. So what would it be at Main and Main in Toronto? Anyone on the panel?
I guess 5.5, 5.25 to 5.5. I mean, that's not to say that there isn't somebody in this room, and there's pension funds in this room, who would pay something more aggressive. But I mean, in terms of what the cover on that bid might be, I think if you had to pick that, and as a lender, that's what we're looking for. We're not looking for that one buyer in the room that needs to get the cash out. We're looking for a more sustainable level, and I'm thinking it's 5.25 to 5.5, but that's me.
I think as a broker, if you had a building in Forest Hill that were brand new, it would be sub 5. I think it might even be 4.5% for that perfect building and things like that. Maybe a run of the mill building.
That doesn't surprise me.
Yes, yeah. Yes. Paula, how do you guys look at cap rates?
So CMHC, we follow the market and cap rate. So I'm listening to Jeremy say 5.25, 5.5. Actually, for good downtown stock now, existing stock, we would look at 5.75. We may push down to 5.5. So new, that doesn't sound unreasonable, but I couldn't commit to it here on stage. We'd have to bring in the deal and see what happens. But 5.5 or 5.75 would be probably within.
Well, and I think we're talking about what market is, not necessarily what we're going to use as underwriters. I think there's two very different distinctions, right? I mean, we're looking at a very aggressive marketplace right now. So we're identifying where we see somebody would actually buy the property, but we're also talking about where we would actually lend on it. It's two very different things.
I think that's a good point. I think the market would be sub 5, on this type of product. Okay, so, a lot of the people here today are condo developers. They've got the development skills, but they don't necessarily have the rental market intelligence experience, the lease-up experience, and then the property management experience. Right, Paula, yesterday you were saying that in student housing, you need the guy to have 5 years experience in student housing, right? How are you looking at the sponsor, who's a strong sponsor, right, financially, and with a good track record, but isn't in the rental business? What flags are you going to go up? What advice are you going to give them? Brian?
Compared to student housing, I'm much less concerned about it.
Yes.
I mean, student housing is an operating business.
Sure.
Apartment rentals is operating too, but nowhere near as intensive. You are signing a 12-month lease. You're not getting the phone calls at midnight for light bulbs as often. Maybe you correct me on that, but it is important, and it is good to keep in mind. So the market would pay a big portion of that. If you're in Toronto, I think you're probably going to lease up. You're not going to have that much difficulty. If you're in Windsor, you're probably going to have to fight for your rents. So, market would be a big part. We'd want to make sure they have an understanding what they're going to do and what their plan is. But I don't think it's that hard to get your head around on the apartment buildings.
We've seen a lot of guys build apartments, and they built their first apartment building, and they sort of proudly tell you that we got it leased up in 3 months. And so what's the mistake they've made?
Too cheap.
Yeah, it's been too cheap. It shouldn't lease up in 3 months. And oftentimes we find that developers who aren't experienced set the rent too low, and then they lease up the building too quickly, right? It's rarely that the developer takes too long to lease it up, and we can understand why you want to get it full, but you leave a lot of chips on the table, and then culturally that just becomes your base rent. And you just start taking small increases on that. So that initial lease up period is critical, and that's where we've seen a lot of developers make mistakes. Right?
I think the initial rent is very important, but as a banker, when you tell us a rent and you give us a projection, we're really looking for you to see you to meet that. If you're trying to squeeze extra juice of the deal, we're not going to be that sympathetic. It's just as an advice piece, and to be blunt about it, we're looking for you to deliver on construction because we go in with full market risk on day one, and if if you think you can get an extra $50 a unit out there, but it's going to take an extra year, we're going to have a hard time with that.
Okay.
Yeah, I would agree with that, Derek. I mean, you say that like it's a negative. The 3 months to me is fantastic. I mean, we want to see it leased up as quickly as possible and get the cash flow going. So
sure,
I understand your point, but
yeah.
From our perspective, we take a different view on it. I mean, every developer that talks to us about an apartment building, it always starts with, I have a waiting list of 28 people. I mean, I don't even understand how that works, quite frankly. I don't know who's sitting around waiting to move into an apartment building 12 to 18 months from now, but virtually every developer comes in with that, I've got this waiting list. Same with retirement homes, same thing, I've got this waiting list. I mean, how does that work with a retirement home?
In the apartment business, it's true. There is a waiting list of people who want to get in our buildings.
Have they signed leases and given deposits?
Well, they're homeless right now. They can't. Yeah.
And Derek, I think quite often the funding is split between a funder for construction and a funder for takeout.
So let's talk about that. Good. Okay.
And quite often they're trying to move to that. They may have already fixed their rate because they want to make sure they take advantage of these historically low rates, which we've had for a long cycle. But again, the horizon is they're going to change at some point. So if they really like the rate they've contracted, they want to move to that. So they need, stabilize rent as early as possible and move to, and usually 75% of rental achievement allows them to move to take out the construction debt and move to permanent debt, which may be where you're going to the CMHC low-cost financing because that's the alternative they're seeking. But that's a two-step program, and it's got thresholds.
Are most developers using a two-step process?
The ones I work with, yes.
So they're going with conventional financing for construction and then CMHC on takeout?
Quite often.
Yeah, I mean, what we're seeing in some markets, maybe Paula can speak to this better, but CMHC is somewhat reluctant to provide the construction financing for our deals. So or maybe it's just at the levels that the developers are looking for. So I would say very often in the we are doing deals that we do a conventional construction piece on the deal, and we may well end up throwing in a little bit of mezzanine to it, but with the eye always to what kind of takeout we can get. And in quite a few markets, CMHC will give us the commitment to insure for the takeout. So we already know our exit is baked right into the deal. So when we do a commitment letter to a client, whether it would be insured during construction or conventional, it's one commitment letter, and it says, here's your construction term, and here's your pricing, and here's how long it's going to go for. Here's your insured deal for the takeout. We've already got the commitment to insure, and it gives the borrower a great deal of opportunity, as Sandy just said, if the leasing is going well, to lock down that interest rate as soon as possible. And in this environment, I mean, that's the smartest thing to do.
So what's the advice you would give people from all of you in terms of, interest rates are historic lows. You don't know where they're going to be 1, 2, 3 years from now. If you're going to build a high-rise today, it's going to take you, just from the entitlement process to the lease-up process, 3-4 years, right? If you're going to build frame product and it's ready to go today, that could be much quicker. How do you think through that piece on rising interest rates? And these deals are working because of interest rates, right? And the cap rates are where they are because of interest rates. Greg?
Swap it.
Swapping, just explain that.
So you can do an interest rate swap, and you can hedge some of your interest rate risk if that's what you're really worried about.
And what's the cost of doing an interest rate swap? Just give an example. I don't know if I fully understand it. Maybe some people here don't understand it.
So, I mean, it's something you can go to your banker about. I've got a couple of bankers on the panel here, but you can go to your bank and you can arrange to fix an interest rate for, 10 years. If you're concerned about, you could actually lock down your anticipated mortgage, or if you want to do a leveraged amount on that to actually protect you against the duration, the effective duration you have on the equity in an apartment building is higher than the duration you have on a swap. So you can actually do a multiple of it, so you can protect yourself against a move in the cap rates, if that's what you're worried about.
If I could just jump in on that too.
Yeah, please.
We do offer swaps. If you need a swap, come to Royal Bank. We offer the product. What I will say is it is a sophisticated product. You have to have a pretty clear understanding of your financing needs going forward. If you're talking 3 years out, that's a long time to swap. There is not just a cost of putting the swap in place, which is tangible. You're going to also have to put up something to get that swap, because there is a major risk associated to the bank or to whoever provides that to you.
Including the margin calls, right, Ryan? I mean, which is a big risk that you have. If rates start to move against you in that time frame, you're going to be asked to put more and more money up, or fear unwinding the swap. So it's a little bit complicated. I mean, I think it's a great idea if you can do it, but it's maybe not the solution that's going to be available to everybody. You've got to be a pretty strong borrower, I think, to do that.
In our experience, it's the smaller, mid-sized people. It's too much of a stretch. It's in the long. You can do a year. Used to be able to do a little bit longer, but it's pretty tough for most lenders. After that, for most people, it's pretty cumbersome unless you're of size.
We have one client right now that is adamant about locking in the interest rate right now, and this is challenging. We don't do it very often, but we're actually doing a 20-year deal for them, fully funded up front. So they're taking the cost up front, if you will, to pay the coupon right from the get-go, even though they don't have all the money, because obviously you draw that money over, say, 24 months. But they're locking the money down today on a 20-year basis, and it's a CMHC insured deal. So it's going to be, I think ultimately, just where interest rates are going, it's going to be a great deal for them, and that effectively is a swap, if you will. I mean, they're ultimately paying in advance for the money. So I think where you have the opportunity to do that, you should try. It's not available, again, to everybody. It is a bit complicated, but for this borrower, it's a very strong borrower, very strong developer. They've built lots of properties, including condominiums, and they're making the move to some rental construction, and they are locking down today for 20 years. And I don't recall the rate off the top of my head, but I mean, it's a very, very, it's a great rate for the client. I think they're going to be very happy.
To just help me understand this, maybe some people in the audience also have the same question. If I had a $10 million loan and I wanted to lock down the interest rate 2 years from now, what would that cost be?
Well, I think it's virtually impossible. I'm not aware of anybody that'll even do it for you, first of all. So, I mean, I think what you're more likely to do is go to your bank and put a hedge in place where it becomes a financial product for you. So let's just say today you think the interest rate is 3%. That's what you're happy with. You put a hedge in place for banking on 3%. You're going to be either in or out of the money at the end of the 24-month period, and you're going to get a cash settlement at that point. again, you're going to have the same concept that I described before. You're going to have a margin call throughout, potentially if rates start to move against you. But it gives you the opportunity to at least participate in the rate in advance. Again, it's complicated. I'd say most people don't take advantage of that, and they really try and limit that window from construction to term. And that's, again, why we talk about 3 months to get leased up. Well, if you want to get your interest rate locked down, it might be just something you've got to give up at the end of the day.
Interesting. Greg, any comments on that?
Yeah, I would say it's not that hard. If you're worried about margin calls, you can do an option on a swap. So, it's a little bit more sophisticated. You need a little bit higher level of sophistication to deal with that, but your banker can walk you through it. So,
can you give us some sense of cost on $10 million for 2 years?
It's really hard to say.
Is it 1 or 2% of the mortgage cost or more?
It may not be that much, and it really depends on the shape of the yield curve.
Right.
So it's, if 2-year money is 1%, and the 10-year bond is 173, so you got a little bit of forward starting risk. So it's a little probably too complicated for me to explain it.
Yeah. Derek, I could say CapRate used it. They used it. They bought a rate collar, which basically gave them an outside band for all of their 10-year product. They did this about 12 months ago or so, and I can't remember what the high end of the rate was, but basically if rates were over 3.5%, they were guaranteed to get basically a financial settlement that more or less kept them on at that rate. So it's a bit of a risk. I mean, if rates stay the way they are right now, I think it didn't work out necessarily for CapRate. That would be my view, not theirs. But I think it's, if you're running a REIT where cash flow is critical and locking down interest rate, I think it's actually a really smart thing to do. But I'm not an expert in the swaps, so I couldn't tell you what they cost. Your banker could tell you, or our Treasury Department would sort of tell you very quickly what that would cost.
Right. So most guys are just taking the risk that 1, 2, 3 years down the road when their building is done, they're going to finance it at that point, right?
That's what we're finding, again, except for this client of ours that has a very large deal, and they've locked down the 20-year interest rate right now.
Right.
We do a lot of forward fixes for 1 year, but they're usually about 3 basis points a month built into the deal. And even that, given the fairly flat rate so far, even though it's looming, some people don't want to pay that, and some do. It's just different options for different people.
You have to have a view to take a swap. And if most constructions are coming to us 12 months out, they're saying, I go to the economic briefings from Royal Bank every year, and we have our chief economist stands up and says, we think rates are going to go up next year. That's been every year for 5 years.
Right.
So if in the construction period, your interest cost and carry is not a massive number. On the takeout, it's a much bigger one because you're in for the long haul. So if you're thinking about fixing your construction risk, your actual, if you get a $10 million loan, your utilization is probably 60%. So you're actually utilize $6 million, so your average cost is $6 million. Then your interest carry on that is, the proportion share of that as well. The incremental's not as painful, so you're more likely to fix the takeout and take that long-term 25-year money and go on that. We do some construction risk, but you have to have a view that the short-term rates are going to go up and go up substantially to justify the cost.
So we need thousands of apartments built in Toronto, probably tens of thousands, to bring us to some sort of equilibrium. We've had a 35-year hiatus from developing apartments. So here's what I'm hearing out in the marketplace. We regularly meet with developers, usually condo developers. Sometimes guys who just own a piece of land that they think is ideal for apartments. They're happy to go through the entitlement process. They're happy to build it to a spec that a purchaser wants or a spec that he thinks he needs, but they're not willing to take the lease-up risk. Right? In fact, I even use the wrong word. I don't think it's lease-up risk. Risk implies it's not going to happen. You know it's going to happen. We just don't know exactly how long it's going to take and exactly what price it's going to be. I would rather call it lease-up variable, right? If we could find a way to bring the buyer and the seller together here, so the developer will build it, bring it to certificate of occupancy, and then have someone come and buy it, right? The challenge is people are coming to the apartment business because they want safety, right? They don't want any risk. And that's why they're prepared to pay the lower cap rates today, right? So we've got a situation where thousands of apartments could be built by competent, well-financed condo developers, landowners, things like that. We've got certainly a group of institutional investors who would love to buy brand new, fully stabilized apartments, right? And on these buildings that we've sold, we've had multiple offers on them and they've been aggressive, right? How do we bridge that gap?
Well, Derek, if I
Not an
could
easy question.
start with that, we've had several clients right across the country start to forward sell their properties. So they lock in a price today.
Right.
You know, we've seen it in Winnipeg, we've seen it in Halifax, we've seen it in New Brunswick. We've seen several in Calgary recently, where they're locking that in today. So I suppose that's one way it's being
What
handled.
about locking, but who's taking the lease up variable?
Yeah, I think I've seen both cases. I mean, I've
Sure.
seen where it gets turned over upon completion.
Sure.
Again, I mean, these are owners of multifamily. If they're willing to forward buy 24 months, they clearly know how to lease up also. So, but to the best of my knowledge, I think that they're basically being turned over vacant. But I've seen both. I've seen both cases.
Okay. So Ryan?
I mean, at the risk of not being invited back, I think variable understates the market risk. As a lender, I mean, that is the hardest one for us to get our heads around.
Okay, is it the risk that it's going to get done, or is it the rent level you're not sure about?
It's not going to get leased. I mean, you're right. It's something will get leased up at some rent level, but I mean, we lend
No,
cash.
but,
we get
okay,
paid
so
back.
let's just top us. We've had no construction for 35 years in Toronto, practically speaking.
Yeah.
There's thousands of renters there. I think we all feel safe about that.
No, but they've been going into the condo market, so I'm not sure I would say that they haven't been served. They've been served by people in this room. So I think that what you're saying now is the condo window's closing. How do we get people now to shift into apartment? I don't think that the debt is the impediment to getting.
No,
it
I don't
done.
think it's a debt. I'm
Yeah.
asking you a non.
It's risk. It's risk.
Risk doesn't mean we won't do it. I mean, everything has risk.
Right.
The question is, how do you get your head around the risk?
Right.
And that's why it's important to call it what it is. And you look out there and you look at the vacancy and you see, 1.2 vacancy, which is really just churn, and you get a comfort with where that is. So then to your point is, well, what's the dollar amount? Because, there's going to be some hurdle for someone to either do a takeout or to purchase, or the person purchasing has a view. And that's the number you got to get a comfort with. And the rest of the stuff, we can get a good cost consultant to tell us what the budget's going to be. We can get a great feasibility to tell us, the cap rate value once it's completed. We can get our heads around the loan, and even the sponsor, which is very important, which I think we'll come up to later.
Sure.
It is easily quantifiable. The market risk is actually really hard to quantify in Toronto with new product.
It's uncertainty, as you're hearing. Lenders don't like uncertainty. You're leaving a gap in between the seller and the buyer. And that's where, because you have to perform for the construction crew, and the buyer has to be prepared to take it almost without. And the lenders are going, where are we left?
Yep. Any questions from the audience? We welcome them now also. So let me just rephrase the question again. What would be the difference in a fully stabilized building with 2 years of financial statement stabilized versus that same building empty, delivered on certificate of occupancy? What would be the cap rate differential, Greg?
Well, I would say aside from...
It's a hard question.
It's a really hard question. So I would say aside from the niche where you're going to get a few cases where someone will be willing to do a forward sale, I think that's a very limited case. The best case scenario for a developer to get the most amount of money is because the buyers that are taking this out are risk averse.
Yes.
We're apartment owners, we just want certainty. So for them to get that maximum price, they have to stabilize it.
I'm sorry, sir?
They have to stabilize the asset to get maximum price.
Okay, so just recap. To get maximum price for a building, you need to understand the leasing business, the property management business, get that thing leased up, get 1 year financial statements. 2 years would be better. But I'll tell you, they'll buy it after 1 year, they'll buy it after 6 months. Just get it full. The market's so strong right now.
Super hot right now.
There you go.
I disagree with that last comment. I think there are pension funds right now that can't put money out. Some of them are in this room right now,
Yes.
and the reality is these guys are going to forward buy at aggressive cap rates. If you want to lock in your cap rate today, you can sell. I'm seeing it down across the country, but it may not be the right way to do it. It may mean that you're leaving something on the table. I'm not suggesting that. It's all about risk, and it's the developer that has to decide what level of risk they want. We're seeing some developers who say, I don't want to take the risk. If interest rates move up, it affects my cap rate, which affects my value. If I'm happy with where cap rates are today and I'm building at a certain level and a certain price and a certain cost, I want to know I get my price. And I can tell you there are very large pension funds prepared to buy today at very, very low cap rates.
Absolutely, and they'll buy for all cash.
That's
so the
right.
interest rate risk is taken out.
It's a simple scenario. Everybody's going to assess how long it takes to lease up, and they're going to run their cash flows on it, and they're going to say, I'm going to go 6 months. But let's face it. think about the old properties that are being sold today in Toronto, Derek, you take 5 different people through, right? One person looks at it and says, well, I need to spend $1 million. One guy says, I can do it for $100,000. That's the difference in price. So if you have a buyer that comes in and says, I can lease this in 1 month, there goes, you're basically getting full bang for your buck as far as I'm concerned. If you get someone else who says it'll take me 12 months, it's going to diminish the price a little bit.
You know, we've just gone back and forth on this so often on different deals that we've done. And let me give you some examples of how we've come to an agreement, okay? So we had a building in London that was 50% leased up, okay? And it was a checkerboard, you know, the 1 bedrooms, 2 bedrooms. It wasn't just, you know, the lower price units got sold. The developer or the buyer wanted to buy it before the end of the year. He didn't have enough sales that year. He needed to get it on his book. And so the seller just put some money in escrow, right, as a guarantee to fund that up to 90% occupancy, but he maintained the leasing. He didn't want the buyer to take his, or the buyer to do it, right? Because he wanted to control. So he maintained the leasing up to 90%, and every month he just, the owner drew down on it as if the building were 90% occupied. So that was one way.
It's the same thing with a commercial deal. When you've got a vacancy hole and you want to sell the property today and you want to get full value for it, you just do a head lease on the property for 12 months, whatever, that type of thing, and you can ultimately get your price, hopefully. Doesn't always work, but you can try.
Yeah, I'm going to describe a second deal too, which was more interesting. We had 2 buildings that were going to be built, one after the other, and there was basically just dirt there and a vision that the developer had, and a set of, not a set of working drawings, but another building he had built that you can go and look at and say, I'm going to build this building. It was a downtown building. It was building in the suburbs. We're going to make it 15-20% bigger. Rather than noodling over the cap rate and what the expenses were going to be and what the taxes were going to be and everything like that, he just bought the building based on a gross rent multiplier. So whatever the rent was, we just multiplied it by a factor. Now, he did his analysis, obviously, right? But everyone was cheering the guy on because his cap rate went down, right? Or his cap rate went up as they got a higher rent. Now, his price per unit went up also, right? So that was a simple way to do it. The purchase and sale agreement was 28 pages long, right? With a couple of clauses in it.
I think it really comes down to risk transfer. And, you've got the majority of the buy market on apartment buildings are risk-averse guys.
Right.
And, someone's going to have to take that risk. You might have a few people in a very hot market who are prepared to take that risk, but someone's got to take that risk. And if you want the largest market for your product, you got to cater to the largest market.
Yeah, so what you're saying, if you want to get top dollar for your product, lease up the building. Just get it full, Jeremy. I don't think we need that 2 years anymore, right? Just get it full. Get a set of expenses for the year, and then you'll have multiple buyers there, and you'll be able to create a bit of a bidding war. If you're taking out a building that's empty, you might have 1 or 2 guys show up or 3 guys show up, but they're going to be conservative and so on. But if you're prepared to take the lease up risk now, I think you can forward sell it, and there will be buyers there on a cap rate number or a gross rent multiplier or some type of formula. You all agree that would be the advice you'd give to a developer? Because they leave too many chips on the table if they tried to sell it vacant? Okay, good. The other issue that you face on these forward sales, and that's really where most of our products are going to come from, is how do I know the developer is going to build the building he says he's going to build? Right? How do I know when I turn around he's not going to put insulation in the wall, he's going to chintz on the carpet, and things like that? And we've been involved in a number of these negotiations, and if you try and get everything pinned down in that purchase and sale agreement, it's going to be a $500,000 agreement from the lawyers. It really is. I think at some point, you just have to look at the developer and the buyer and say, listen, the most this guy can save is 5% on construction cost, by chintzing on this thing. You're a great source of money. You're a great developer. You can do many deals together. And if you can trust each other and get the first deal done, this thing will happen. If you try and paper this thing to death, it's just not going to happen. And it'll just be legal fees in the fight, and you'll just constantly be doing that. The hard part is getting the first building built. And in this deal that we're doing, the first building got built, the developer delivered everything he said he was going to deliver. It took 6 months to get the deal done. Second deal got done in half a day. The two of them sat there, he built, he delivered what he said he'd deliver. They were over the trust hump, right? And to me, that's, in that final meeting we're having with the developer and the buyer, is that look at the guy, do you trust him? And if you do, then you'll probably get the deal done. If you don't, we probably shouldn't go any further. Just any comments more on forward sales? It's so important that we figure out a way to get this thing done.
Another approach, we are buyers in the space. We're also mezz lenders in the space. So, there are choices to partner with people. So you don't have to necessarily go the forward sale route or go to the try and fully stabilize it yourself. You can partner with firms like ourselves that are looking to do this to mitigate some of your risk and still obtain top pricing.
So maybe a partnership between an operator and a developer where they'll maybe share that risk, right? And they've got to be aligned and they've got to be in it for the long term. Because sometimes what happens is if you let the purchaser do the lease up and determine the value based on his rental rate, well, he may not want to get the highest rate in the first year. So the developer says, I got to control that. So being aligned often might solve that
But you can
problem.
bridge that with using a third-party leasing consultant, right? So that you've got a trusted third party who's
both sides
incentivized and
agree on.
paid, that both sides agree on. So you can bridge that. I mean, we can lease up because that's what we do all day in our portfolio.
Right.
But we understand that we have obviously a negative incentive for the developer to lease low. So in those kind of cases, unless there's already a lot of that trust in place, it does make sense to go to a third-party consultant.
Okay, great. I'm going to ask you at the end of the presentation to give the good people here who came a long distance, paid a lot of money to be here, one piece of advice you've never said publicly before. Okay, you got 5-10 minutes to think of that. All right. So, next question. Where do lenders and borrowers' expectations differ most significantly? Like they're expecting one thing, they come into you. Where's the disconnect sometimes? What advice would you give these guys when they're bringing you, a building to build? Brian, you want to start?
I mean, I think the biggest difference is you're building to create value. We're lending to get repaid.
Right.
Unlike my friend next to me, we never want to own the building. We want you to be successful. We want you to take us out, and we want to shake hands and walk away.
Right.
So when we do our projections and our net income, we're looking at a stressed income scenario for what's going to happen 5 years from now when we renew this mortgage. When it comes to cap rates, there's been talk on market cap rates versus the cap rates we would use as lenders, and even for expenses and that kind of thing, we're thinking, what would it be if it wasn't you who managed it very well? What if it was us managing the property?
Right.
So I think on the income, which drives everything from there, is probably where the disconnect would be.
Okay. Sandy, any comments on that?
Yeah, their clients are basically underfunded. They haven't got their full package together. They prefer, they hope not to have as much equity in place, and whether they need other investment partners, mezzanine debt, they need to be prepared to be successful, that they're covered off the construction risk, which is more than just the equity at the outset. And a lot of times they're just missing the full understanding of what they need to go forward.
Jeremy?
I'm still thinking about what I'm supposed to say in a couple of minutes, actually.
Make it good.
Yeah, I mean, I think it's just optimism of the developer versus the way we see things. So I think that's the biggest disconnect we deal with is how quickly they expect things to happen, and their rose-colored glasses versus, let's face it, banking is more conservative, as Ryan said. We do not want to take it back, so we want to be a little more careful, probably.
Okay. Greg, as a mezz lender, where do you see the disconnect with the guys walking into your office?
Biggest disconnect. I guess it would probably be pricing expectations. We've seen projects where guys walked in and thought, well, we're going to get a 4 cap, and just said, good luck with that. It might happen, but you just can't underwrite on that basis, right? So you have to, we know at what price we'd be prepared to support a deal. We also have a view as to where other people would be prepared to support the deal. But you have to be very careful when market is the market is a little bit nebulous, and peak pricing is, a little bit risky or quite risky. So you have to be very concerned about what your shock value is. If you don't get your end number, I mean, where can you get out and still make money?
Sure.
So we're seeing a lot of marginal deals coming across, and because they're assuming they're going to get peak pricing, we have to say, no, you have to assume that if you build this, what's your worst case?
Right. So how far along in the development process, should a guy be coming and seeing you?
Feasibility study in hand, site already tied up, site plan. Like, he's almost ready to stick a
Put a
shovel,
shovel in the ground.
but maybe a few months in advance. But other than that, everybody's wasting their time.
Okay, great. Okay, so last question. Paula, we'll start with you, work down. Give these guys one piece of advice to help them build apartments.
I would say do your homework, know the market. If you don't have the experience, partner up with somebody with the
Yes.
experience, and make sure either you or they have deep pockets, because there will be guarantee requirements, strong ones.
Okay, Greg Romundt.
I'm going to cheat. I'm going to say what I said yesterday, which is pay attention to your risk. So, when you can look at a development performance and it looks really, really attractive, focus on your worst case, because that's what sometimes might happen.
Okay, Ryan?
Similar, I'd say don't hide the dirt. If there's a bit of hair in your deal, there's a bit of hair on every deal. Address it and resolve it and frame it yourself. Don't let the
Great
people you
point.
talk to frame it for you.
Don't let the lender frame it for you. Give data with something. Great.
I would frame it well, but other people might not.
Yeah. Okay, Sandy?
Yeah,
Great
other
point.
Other than Ryan, your bank isn't always your best friend. You need to understand all of your options. And unfortunately, there's lots of layers of bureaucracy at some of the banks, and they can be positive and they can be misleading in that you aren't going to get the full information you need for the complete package for your whole loan, which is right through construction to takeout. That's important.
Okay, great. Jeremy, last word to you.
I think I would say just pick the right people to work with, and I mean that run the gamut in terms of all people involved in your project. I mean, I've just seen people try and cut corners on lawyers. This is my lawyer that did my divorce for me. I'm sure he can do my construction financing. Probably did a bad job on your divorce too, but the reality is you shouldn't be using them. So. I've seen that, and that just it obstructs the deal. It gets in the way. It becomes even more costly. But that's just an example of one consultant through the piece, all the way to the lender you choose, or the consultant you maybe bring to the table with you to find you the right debt. Pick the right people that are experienced with it, because it's going to save yourself a lot of time. Focus on what you're really good at. Don't focus on trying to do every little piece yourself and save a little bit of money here and there. Rely on people who are experienced and bring a lot of knowledge to the table. It'll be well worth it for you at the end of the day. You're dealing with nickels and dimes. Focus on the real issues.
We see a lot of developers come into us saying they have a vision for their property, and we do these feasibility studies to just bring that vision into focus. And a lot of times, the deals work, and they just haven't penciled them out properly, because they haven't got the rent right. So we do these feasibility studies. We have some outside if you want to look at a sample of them. And first, just help me thank the panel. This was terrific, very, very insightful.